also create friends and have, you need to know yourself very well. So that, I mean, some of us are dispersed across. So taking Accra as, let's say, the center, or the, say, the mean of all the cities, we are dispersed or deviated across the region. You may come to Accra, you want to see somebody or want to do anything. And I mean, if you know somebody, I mean, not necessarily because the person is your friend, or what do you call it, a family member. I mean, coming to the university also creates friends there. And I mean, after university, friends helps ourselves a lot. Even whilst we are in the university, we help ourselves. So normally I prefer that we show our faces, at least to identify, to know ourselves for the first time. Though we come to the, we have opportunity to meet in the classroom. So first of all, I don't know, today is the introduction. Can we show our faces for us to understand? Is it possible? Is it possible for us to do that?
Yes, sir. Yes, sir. Yes, sir.
Or some of you disagree with me? Yeah, so we have our handsome faces showing here. So let's show ourselves, our faces. Doc, are you here?
Yes, I'm here.
So is it possible for your student to...
I'm trying to show my face.
Nice, nice one. Yeah, so I told her she's really a female. All right, that's fine. Yes. Yeah, so we have Sam. Yes, the others, can we show our faces, no matter how or wherever we are, if it's possible. I mean, it is part of the education. We have seen second, somebody's working as second, so the person may provide that good or quality, high quality paints, isn't it? The seconds man. Me, I need seconds paint for my car. So, yes, so we have Samuel Tete showing the face. Yes. And then again, who? Martin also here. Veronica Jekum, Patient Mauli Boatin, Jay. Yeah, so let's show our face. Curtis, a friend is called Curtis. So Curtis, you have Adam Kujo Ajay, and Derek. Yeah, so yes. Oseboatin, you can see your face. I don't know if you are busy. So that's fine. That's fine. So at least we have seen some of it. So we try to make ourselves, we say we come to the class and we have to create friends. Being a lecturer also even create friends. I mean, with the, I think about 3 days ago, I contacted our previous class, Dr. Bright, one of what do you call it? The class that we taught, one of them, not knowing that he's a businessman, somebody told me, and I needed to do certain things, do some importations, and I mean, I wanted to build upon his experience, so I have to contact him for some directions, right? So we build. It is important as we gather here, we know ourselves, and I mean, we see ourselves. So thank you for joining and showing your face.
Okay.
Yeah, thank you. So I'll show our course description now, so that we know the contents that we expect Raleigh to study. So this is our course description. we have the course name and the course code. The course code is FIN 613. And then we have the financial markets and institution at the course name. This is a 3-credit course. And I believe that all the courses that you're doing, they are 3 credit hours. And the hours gives the weight, the importance that we place on the course. In academics, some of the courses are 2 credits. One, some of them are 3 credits, right? So it gives us the weight and then the importance that we place on there. So this is the core description. Yes,
Hello,
it is.
Doc.
Yes, please.
Can you please zoom the screen?
Okay.
Yes, please.
Is it okay?
Yes, it's fine. It's fine. It's fine now.
Okay. So this course really is developed said that it will also, please just a minute. Okay, so really it is built on the principles of financial finance and then financial intermediation.
To the reward distribution.
Right. Yeah. And we equip ourselves with this knowledge, and as we get the knowledge, we also develop, it help us develop special or unique skills in investment decisions. You know, in investment, you need special skills and how to be sophisticated minded to conduct critical analysis of the market. And once we are able to get the principles well, it will help us do critical analysis of the market. So the theories I said, the principle they are going to build, they are just the theories. The theories are there. We have the financial principle, the financial theories concerning investments, concerning issues of financing and intermediation, financial intermediation principles. These theories are there. Now, when you talk about financial intermediation, now in businesses need funds or individuals need funds to fund their ideas or investment opportunities, but they may not have enough. But there are special institutions or organizations built and said that they can connect deficits, those who are in deficit in terms of financing, and those who also have excess, right? So in the real world, we have those who are in deficit, other institutions or individuals, but they have ideas, they have opportunities of investment. or the funds that they have may not be adequate. So they are in deficit to fund or finance their ideas or investment opportunities now. And they need funds. There are other individuals in the market that also have enough or adequate, they are in surplus of such funds, right? So if you see funds as, say, a commodity for now, others have it in surplus, others also have it in the position of deficit. But we need institutions to connect the deficit spenders or those who are in deficit and those that also are in surplus, right? And that process is what they call the financial intermediate connect, the process of really connecting those that need funds and those that really have surplus together, right? Is what they call the intermediation. So there are intermediaries, financial intermediaries in there. And this occurs in the world. But there are theories that practically guide this to be done well, right? So this course would enhance our understanding also on the role that the financial market plays, right? And in this course, the emphasis is on the various financial players, the financial instruments that are in the market, right? And it will build our knowledge really also on knowing the issues about returns and risks. And investment is characterized by risk. Yes.
Return.
So it will also build our knowledge in understanding the risks involved in investments, especially financial investment, right? So the main course objective is by the end of this course,
students will be able to explain the financial models for determining the present and behavior of interest rates.
Yeah. Somebody's reading, so you can read. So you can read. Continue.
Okay, sir.
Henceforth.
By the end of this course, the students will be able to explain the financial models for determining the pricing and behavior of interest rates, foreign exchange, securities, and diversities.
Yeah.
Organizing research activities and presentation on topics related to financial markets and institutions. 3. Explain the relevance of the principles of finance and financial intermediation to real-world situations.
Yeah.
Course contents: financial market, money and capital market, primary and secondary market, OTC and exchange market, financial securities and market operations, financial market activities, speculations, hedging and speculators.
Okay. So our course content, this is the course objectives. I mean, by the end of this, we expect that we should be able to, as a students, be able to model the price behavior, right? How price really can be determined. Okay, how price can be determined. And then we also know, so in determining, you need to know the determinants or the factor that influence price of financial assets, right? What goes in, what influence, what are the determinants, right? And then how interest rates behave, foreign exchange, and then also we look at securities, the models really in securities and derivatives. We explain this terminology as we move on, right? And then we should be able to conduct research activities and then present them right in class, or even by the end of your course. We will do a research, and that is an independent study, empirically utilizing the theories or the ideas, and then data to really make findings, right? And also we should be able to explain the relevant principles in finance and financial intermediation, right? Yeah, so some of you are going to do, some of you, please, just a minute, I'm giving a key. So. Okay, so our course, sorry for the narrative. Our course content really is in 3 segments, right? We look at financial markets, and then the institutions that are in the market, right? And then we look at some important financial instruments covering bonds, equity, and then debts and derivatives. All right, so the debt it is same as the bond, so you don't worry. And then derivatives that we look at. So later on, understand what derivatives are. These are special instruments for hedging purpose, right? We will talk about them. So this is it. You'll be given assignment, and case study analysis will be given to you. We expect, as I said earlier on, the class to be involving, and therefore discussions, and that was really help make the class very interactive. So we also establish groups, right, that you do some presentations in course of time. These are recommended reading materials. I'll make some of them available for you. Personally, I will share part of the books with you. We are not supposed to give out the entire book. I mean, that is illegal in somebody's access. So we'll try and give portion, the chapters that are important to you. I will share them maybe by tomorrow. I give all of them, gather all the necessary materials for you. And so these are some of the recommended textbooks that you require. So today, quickly, we will talk about the financial market. We talk about the financial market, covering money market, capital market, and the rest. So that is what we are going to talk about today. When are we supposed to end this lecture? Well, at what time?
6:30, sir.
When are we supposed to end the lecture? Did you hear me?
6:30.
6:30. Okay, good.
We're going on break at 4.
You break at 4.
Yes, sir.
And then we come back.
Okay.
Yes, sir.
4:30.
There's a 30 minutes break.
Okay. So let me share. All right. So we are looking at the financial market today. Financial market. Yeah. Let me ask. In your view, on your own view, what is financial market? What is financial market? In your own view. Just be fine with what knowledge that we have. I don't know. Okay, I didn't even ask of your backgrounds. In fact, part of it so that we can factor in how we are going to. I believe that not all of you have done finance before, isn't it? Not everyone. Some of you.
Yes, sir.
Yeah. Some of you are coming from different, with my experience, from different even a program that you did undergrad, but you are interested in finance, and so you are diverting in there. I believe that we have a number of you here. Yeah, so fine.
Doc,
Any
can I
knowledge
try?
about, yeah.
My brief understanding is that financial markets are platforms or markets for trading financial instruments, such as the bonds, the debt instruments, and the others.
Okay. So thank you. A market for trading financial instrument. Good. Any other?
Okay. Doc, when you
Yes,
talk about
Kenzo.
financial markets, it's the first any place where buying and exchange of financial instrument take place.
Buying or exchange
Of
that financial market takes place. Okay. All right, good. Now, imagine this, assuming that you have an opportunity to say start a business. Now you have done all your projections about or forecasts about the business or the projects that you want to embark on, collected all the data, you have done all the analysis, and the analysis reveals that yes, the project is let me use the terms that usually used in the market there, is profitable, right? The expectation of the project is very good, but you need huge funds or capital to support the project. You don't have. Now, others also have in there. It could be some of your family members. It could be other individuals, right? That have. Now, assuming that we don't have like some of the things that you said, a place where you can go directly and have access, but I mean, you have to contact other people or individuals that have either in your community or elsewhere. What are some of the challenges that you can face in raising funds really to finance your project or your investment? What are some of the challenges that you, yeah.
Please, can you increase your voice more, since your voice is a little bit down?
Hey. Sorry. Please. So I'm saying that. Is it clear now?
Yes, please.
Yes, sir.
Okay. I'm saying that you have identified a project that you think that is viable, as normally they say. You have done all the valuations, and it reveals that yes, it will give you a very good return. Yes, the expectation is very good, the returns on it. Now, you don't have enough funds to finance that activity or business. But you have somebody you think, and in any community or in any country, there are some that will have some funds that are really in excess. And I said that it could be your friend, other members of the community that you live in, or it could be some people that you don't know that you think that they have. Now, you need funds to finance your project. Now, what are some of the challenges in the absence of, say, because you have already, some of you have already given us what financial market is. I'll come to it later. Do you anticipate any challenge in the sense of, let's say, a financial market?
Yes, Doc. Yes, Doc.
What are some of them? That's what we want us to discuss. Assuming
Okay.
we don't have financial market, as you define or explain.
Difficulty in getting collateral.
There will be difficulty in getting collateral. Okay.
All right. Doc, my submission also is this. The availability of the fund itself is in question. The cost of financing.
Yeah.
Sorry, sir.
Continue.
The cost of financing is also another factor. And then another challenge also is the terms. As the person giving it to you for just 1 year or for a long term, there are all issues which will come up.
So will come up. So these are some of the challenges. If you have to contact individuals, even if you are fortunate to contact individuals, these are some of the challenges. Even if you contact your brother, I mean, there are trust issues, isn't it? A family member. We all know practically there are trust issues.
What if you die?
So a family member may even have, right? But they may not make it, as you talk about availability, made it available, right, to you. So yes, what this is telling us that financial market is very important. Having an organized market, right, where we can access funds, we connect those that have and those who do not have together is very important. Like you go to at least you want to buy engine for your car or paint, as we have the seconds mine with us. Paint, I mean, you can either go to the market straight away where they sell the paint, or if you're an engine, walk to Accra, maybe a place that they sell it, Makola or whatever, also a kind market, whatever, that really you think that straight away if you go there, you can get it easy. You go there easily, right? With a certain degree of confidence that this item that I'm looking for, all things being equal, there's high probability of getting one there. So it's become easier, really, to get whatever you get there. So in the same way, in the financial world, market has been created, right? Market has been created. The market has been created, right? And we need to understand the structure of the market, how the market is organized, right? The various classifications of the market, so that whatever that you want to, any investor or any individual that need funds or others that have surplus, they can really identify straight away which market that they have to really do their business, right? So we have several, the market has been structured or segmented. So we will look at the segmentations in the market, financial market. We'll look at some of the classification involve money market, and then we have the capital market. It's also classified based on seasonality of the claim on primary and then secondary market. The market, we also have the OTC market, which is known as the over-the-counter market, and then have the exchange market, where organized market is there. Now the market has also been, we are not living with the openness of the market of almost every economy now. Every economy is open to each other, right? And the financial system or the intermediation system has become more liberalized. And for that matter, the financial activities are also become internationalized now. There are cross-border activities. In fact, in my PhD, I did something on cross-border linkages in the banking system. No market these days really is independent. Markets become more dependent now. And so the dynamics, the things that goes in each economy right now, more or less connected to others, especially if they are trade partners, right? So market has become international. So we see how the nature of the internationalization of the financial market. We see even in the banking field, there are cross-border or have Pan-African banks here in Ghana. And most of my research that I'm doing now is on that. So the dynamics, the evolutions of, say, things happening in the financial market, let me put it that way, more or less, it's not domestic only, but also it also evolved or development from outside, external factors also influence whatever happened in a particular market, a domestic market, say Ghana. So the market has been internationalized now, and investors can invest even in foreign markets, right? Now there are certain financial activities that goes on or strategies that market participants or investors use, and we would discuss them. We look at speculations, hedging, and arbitrage. In the market, these things goes in there, right? We have if speculators there, we have hedgers there, we have arbitrageurs in the market. When we look at the market participant, this group of individuals are there. We look at their characteristics and what actually happens. So let's look at what financial market is, as some of you really said. I get messages, so let me read a message. Let me read the messages. The sound is down. The sound is down. Hello, is my sound still down?
It's better.
So we have financial market. So it is a special market devoted for the creation and exchange of financial assets, right? It is a market that is devoted or specially designed for the creation. So in the market, financial assets are created. It permits, it facilitates the creation of financial assets. And then when it's created, it also facilitates the trading of it. The trading of that particular financial assets. And there are several financial assets that are in the market. So the trading of it is what is called the exchange. So there's buy and selling in the market. So it facilitates a market that is created to facilitate the creation of financial instruments or financial assets, and also the exchange or the trading of it. So that is what financial market is, right? So it is a special market. Now, traditionally, we have some traditional financial assets, debts. So, for instance, in the banking system, in their intermediation process, debt is created. Asset is also created, right? You go and borrow. You borrow, it becomes a liability, right? The bank creates an asset. The loan that is given to you is an asset of the bank. Even though they serve as intermediary, it becomes more or less the deposited assets with the borrower. So the market is designed, right, to create assets for others, and while also creating liabilities for others, right? So when it is created, the asset is created, it's also facilitate it trading, exchange. Now you go to the stock market. These are some of the traditional markets already in finance. And they have their instrument called stocks, or others will call it shares. Now, when you are a participant in the market or investor, the stock market has been organized. That is an exchange, organized exchange. But it has permitted the creation of what we call shares. These are instruments, right? And whenever you buy such instruments, it becomes your asset, the investor's assets. That gives the investor certain rights to have a claim on the company or the firm that sold the shares to that investor. Now, so the asset has been created, let's say shares. Now, when it's created, there are individuals called investors that are interested to, say, supply money or funds. In economics or in finance, we can say that they want to postpone their current expenditure and hold it for the future. Now, as they forgo their current expenditure, they expect a certain returns or benefits for suspending their current expenditure and using us as a fund supplied to a company or any firm. Now, when they supply, they take risk. So they also expect some returns on it. So to the supply of the fund to the company, it is an asset. But to the company, it becomes more or less a liability. So in the market, we have those that supply funds and those that also demand funds. They demand funds. Suppliers of funds supply, but instruments is created that will be exchanged, documentations, certain terms or agreement guide this for the exchange to take place. Now, if a current investor want to liquidate or sell his or her assets, the system or the market also facilitates the sale of such asset, where it will facilitate its exchange to a different investor who might be interested in the acquisition or buying of that or holding such assets. As we move on, we use the technologies. So somebody, as today, the investor, existing investor may want to liquidate or sell the assets. Somebody, there's a potential investor out there who also want to buy. So the market also facilitates this. In the market, somebody wants to supply money, funds. Some also want to buy funds or buy money. The market will facilitate. There are institutions like that, like the banking institutions that organize this. So we say that is a market that allows the creation and exchange of financial assets. Okay, exchange of financial assets. And in fact, financial assets, we can say that they are intangible assets. These are some of the characteristics that they are intangible assets. Okay. Unlike the acquisition of, say, land, these are other alternate investments, right? Acquisition of land. Now, these are tangible assets. Buying cars and all those things are tangible. But when you buy financial asset, it is classified as an intangible asset, right? Basically, it comprises an agreement between, say, two parties, right? In which the supplier of the fund in the market is entitled to claims right on the financial expected financial flows of the buyer of that fund. You sell fund. If you are an investor, basically you are selling a fund, right? But it give you rights that whoever takes that fund from you or buys from you, for instance, you are entitled to interest if it's a loan. If it is shares or equity, you will be entitled to dividends, right? So it gives you certain rights to have a claim on the future proceeds or the cash flows if it's shared of the company. If the company really sells shares to you, you are entitled to the proceeds that the company generates. For instance, the net gains or the net profit will be shared among the shareholders. So that gives you certain claims, right? Now we can call financial assets as financial instrument, or financial securities. In short, securities, right? And they are interchangeable, right? If you look at their character, they are interchangeable. If you buy shares of MTN as an investor, you can sell it to other interested investors if you wish, right? So if you have a bond in government, say if a government issued a bond and you bought some, if you like, you can trade it. You'll be issuing a certificate of it. The bond, more or less, is a loan given to the government, but you'll be giving certain instrument or certificate. And this, you can trade it, if you so wish, to any party that want to also buy. So there's a market where you can trade this. You can exchange it, right? So today, those who are holding MTN shares, if you need cash, you can trade it. So exchange it. If I've sold a bond, a government has sold a bond and you have purchased one, you can still also sell it. Now, if you look at the segmentation of the structured financial market, now it has been structured or segmented into direct finance and indirect finance, right? There are other dimensions or segmenting of it. Okay. In the direct finance, it is when borrowers, right? The borrowers and lenders interact directly. Okay, they interact directly. More or less, the borrower identifies those who is able to identify those who are willing to, okay, provide the funds. Now, if we are supply a lender, the lender also is able to identify the potential borrower. And then invests in that borrower's activities, let me put it that way, or supply or give the loan. So in the direct financing segment, the lender is able to identify directly the borrower. But in the indirect finance, you have to go through some intermediary institutions. Okay? Institutions. So we have intermediaries in the market where the supplier of funds, in this case, the lenders, do not necessarily have to know whoever wants to borrow or the borrowers. You need not to know the actual borrowers. The interaction really, there's first interaction that occurs between the supplier or the fund or the lender, more or less, that goes to the intermediary institution. The intermediary institution will find the borrowers to take that money. Right? So here, if we are to come down, we got in the indirect finance, there are three parties: the lender, the borrower, and then we have the mediator there. Yes, Emmanuel.
Sir, I wanted to know if you can give us an example of the direct finance. The direct finance.
I'm coming there. Yeah. Good. So for the direct finance, MTN years back decided to come to the capital market and put in that way, you understand it, to really raise funds. It might be about 10 years ago, 7 years or thereabout, I'm not sure. They came. Initially, they were doing their business somewhere. They wanted to raise funds. So they came to the Ghana Stock Exchange to issue shares. Individuals were interested. Those who were interested, they bought some. Now, at the time, there were so many companies that were looking for or issuing, say, or looking for money, in this case, long-term funds. That's capital. But individual investors that participated in that market at the time chose to buy MTN shares directly. They identified that, yes, we need MTN that we want to invest in. Though we have, say, GCB we have other companies there, but the individual investor at the time chose to give their money to MTN. So they made a choice. They identify the company that they want to invest in. So the money that really went into them. So though it occurred on the exchange, right? The Ghana Stock Exchange facilitated this. They did the registration for processes, and then, if you like, they registered MTN and permitted or facilitated MTN to issue the shares, advertise it through their investment banks, and so forth and so forth. Individual identify. But the individual investors that participated in that activity at the time made their own choice. So if you're an investor, you know that you have invested and your money went to MTN's account or MTN company, right? Directly. Now, yes.
Sorry again. So just here in case I wonder, maybe I have a brother. I've asked from the beginning your presentation that maybe you have some project you want to finance, and I went direct to a family member. Or can I also be termed as a direct borrower, the lender?
Yeah,
that was the term as such.
Yeah, that is direct. You went to your family member and they agreed, the family member agreed to lend you. So a direct interaction that occurred there. And you, in this case, you know, the brother knows who has taken the money directly, right? Now, if you come to the indirect.
Hello, sir.
Yes.
So what about personal loans? Where you walk directly to the bank, you pick a loan form, and then you fill, and then the money is given to you.
Oh, okay. Okay. So the question is, before I come in, let's discuss it. Is it direct or indirect? You go to your bank, personal loan, go to your bank.
Sorry, I would say it's indirect.
Why?
Because the bank serves as an intermediary. Because the bank will take the money from either depositors or identify someone who has the money and give it to you. The banks actually don't give it direct to you. That's my submission.
Okay, thank you for your submission. Any other supporting submission or coming with a different position? Any other? Any other view? Oh, let's share. Yeah.
I think it's direct because here the person walked straight to the bank, gave out the details, and the bank also knows the person who is coming for the loan. So it makes it direct. And I think that it becomes indirect when there is a third party. You are going for a loan from someone. The person is also going to take the money from a different place to bring to you. And you also don't know where the person went to take the loan from. And the person giving you the loan to maybe that financial intermediary doesn't also know the direct person who is coming for the loan. But let's say a company stands in between the person coming for the loan and the person going for the money from the other bank too. So that becomes indirect to me.
All right. Thank you. Exactly, your explanation is admitted, and therefore taking loans, those that go to banks, is indirect. If we look at your explanation, it's very good explanation, but that supports banking loans, right? Now, if anyone goes to the bank, now this is how banks operate. Banks financial intermediary that connects borrowers and lenders together. In fact, theoretically, the true lenders are not are the savers or depositors, right? The true savers, they have surplus funds. I don't know if you are working and or whatever, you get any excess fund, you deposit all in your account, right? Now, whilst you deposit that amount there, you don't know those who will come even for that. The money will not be sitting there, right, until you come or until maturity. This money will be transferred to borrowers, those that need the funds for investment or whatever purpose. So in the banking field, like that, the banks are seen as purely intermediaries, and they do this for a fee. So like what you are saying that in your explanation, the banking institution serve as a third party, right, connecting the savers. The savers are the same thing as lending. So in finance or in economics, we can say that we have lender savers. The lenders are the same as the savers. They are the true lender. They are actual lenders of money, right? So they lend. The banks serve as an institution that mobilize savings. Okay. If you look at the previous question that I have now, this is a market that has been created. It's a market that has been created to avoid difficulty and the challenges some of you really said earlier on. Now, in the absence of a well-organized market, there will be difficulties for borrowers or investors or individuals getting a large volume of money to support their projects, right? Capital or long-term funds in terms of size as sort of term of maturity, one of those things, it's very difficult. Now, if you need even about 100,000 Ghana cedis, now for a project, you have to work and go through, maybe go from town to town, whatever, in the absence of, say, a well-organized market. It will be very difficult, serious, time-consuming, and very expensive looking for money around when we don't have organized markets where you can go and then you can take money. But now, the banks really have been licensed to organize funds to make it ready for borrowers. They also have been licensed to mobilize funds in the form of deposits and made it ready for potential borrowers. So if you take yourself as somebody, just as an individual, that have an access fund, at the end of the day, if you are paid, you have access, but you want to say, save it for future. It may come in your mind to go to a bank and place that savings there. Now, the bank will accept it, create an instrument for you, maybe give you a document serving as evidence that they have taken your money. That is where they create an account. And the things have been digitized. So even with that savings account or whatever, you can still be fine. In those days, instruments were created, evidence given to you, you have your savings book. And whatever amount that you deposit in there is written in there to acknowledge the receipt of that money. And so the banks will facilitate. It's not only the banks, but I'm using the bank. We have several intermediaries will come in. They will facilitate the mobilization of the funds from individuals. And then make it available for those that want to borrow. Now, if you take yourself, if you are the saver, you put your money as deposit in the form of deposit in the bank. A borrower may come for your money, right? The deposit. The bank will forward that deposit or that money that you have in your account to that borrower. But you, who is the depositor, doesn't know actually who has taken your money. Isn't it?
Yes, it is.
You don't know. You can identify whether Kwesi Mensah, Kwesi Manu, or Fifi has come to the bank to take your money. But you have lent your money to somebody, a borrower, indirectly through the bank, which you do not know. But the bank will act as an agent on your behalf, as an intermediary, and screen to identify those who are good borrowers before they forward their money to them. And then on your behalf, they also ensure the collection of the repayment of the loan on your behalf. Okay? So when you save, the money is given in the form of a loan. It is for you, it is an investment. It is an investment. To the saver, it is an investment. But this money will be given to somebody you don't know. You did not actually identify. Perhaps if you yourself have gotten to know the individual, you would never even give your money to that individual or that borrower. But the bank does that on your behalf, collect everything. If you give direct to your brother or a sister or a friend, yes, we can consider that one as direct. There's no intermediary, and you yourself have to work hard, ensure its repayment. The person that also, the borrower that comes to you, if he's a friend or whatever, comes to you directly and deal with you, and the terms are agreed directly between the two of you. Right? So far as the principles of economics and finance are concerned, when you borrow money or when you save money, you are a lender. You are the lender. In economics and finance, you are the savers, are the true lenders. Banks are not lenders. Even though sometimes we call them as lending institutions. But the theory underpinning the creation of banks is said that banks are considered as intermediate. So they do financial intermediation activity, helping borrowers to get money and then helping savers to save. That's all that they do. And they do this, offer this service for a fee. They offer this service for a fee. I hope. Yes. Ima.
Yes. Is it possible to instruct the banks not to lend your money to any person after depositing your money at the bank? Is it possible?
That is not. It's not possible.
Okay,
Legally,
okay, sir.
Yeah, once your money goes there, you can't say that, oh, but once you double your money there, do you not, what do you call it? It is no more, though, it tends to become figures in your account. Yeah, it doesn't become figures. When you submit the notes there, you can instruct the bank that for this note, I've identified their unique numbers. Don't give it to anybody. You can instruct them so that when you are going to collect your money or you are going to redeem your fund from the bank, you then will identify whether the numbers, the serial numbers on your eye are the same. I mean, Ima.
Yes, sir.
Yeah, so that is by law, that is not allowed. It's not. You can't instruct bank. Then don't take your money there. Accra, in the olden days, people people used to save this thing in the under their pillow and all those things. Things have changed. So we are teaching some of these things, and you have to teach banking itself. Then we can go into details. Things have changed. Transformations have happened, right? Unless, of course, they are rare items that you can instruct a bank, and definitely legally they cannot give it to anybody. Yeah, banks, when we go to the bank, they also keep assets of individual, even marriage certificates, gold, and other things. Okay. But in the olden days, people used to keep their gold and other silver and other things in the ground. If you remember our great what do you call it? Great fathers, grandfathers, and all those things. They used to keep it in the farm. They keep the gold, they keep all those things. But later on, they got to know that even some of them place the gold and other things somewhere, and they cannot identify. After they are dead, nobody can find it anymore, right? But with the modernization of activities, the people thought it wise to have a place to keep this asset. So banks that not even keep only more savings of money. No, they have other items that, if you like, they can keep for a certificate and other things for a fee. For that one, you can instruct them. Definitely, they can't give it to anybody. But when it comes to money, no, you can't instruct them. Don't give this money or this notes with this serial number to anybody. Once you keep it, the next day is gone. You'll find they will find somebody to give it to that person. Legalize. They have license to do that. That's why you cannot operate bank without a license. You can do some of our activities, enter into circle and begin to sell mobile phones, even when you don't have license. You can get the other activity, but you can. And bank is a special institution created to function as intermediary to support the growth of the economy, right? And so they are ensure whether they are well capitalized. In fact, if you have to go into the theory of banking, we talk about capitalization of banks. In fact, if you look at the financial positions of banks, right, that is their liability asset. In fact, if you critically look at it, deposited funds really as greater than the owner's own fund or the equity in the all over the world. Yes. So banks really are run on deposited funds. And it's the reason why always central banks all over the world keep their eye on them, because they are holding people's fund. And therefore, you need the owners of the bank how to be adequately capitalized. If you are coming to open a bank, we have to make sure that even though the capital that the owners want to start with the bank, it may not be enough or greater than that of the what do you call, but at least a proportion of it. We need a certain amount before you can be licensed. In fact, it became a debate when at a certain point in time, the central bank, the then government, task or require the banks to increase their capitalization or capital. Otherwise, you will not be allowed to operate, because it was based on the risk that they had identified at the time. In fact, it became a political thing, this thing in Ghana, but no Ghana, everything can be. And those that could not provide enough equity, either you were asked to merge with others or you stay out of the market, because we cannot allow you to handle others' fund where you are flesh. Theory, people say that if you have say a lesser flesh in the system, you become reckless. But if you have greater flesh, you yourself have flesh in the system that you are operating, you take good care of deposited funds. It was some of these theories or reasons that motivated the increase of the bank's capital or capitalization. And over there, that is what is happening. If you don't have adequate, owners do not have adequate funds, then you cannot be allowed to, because you are coming to handle greater deposits, right? And the amount is always greater than what the owners of the bank provides. And so, coming back to our lectures, taking loan or saving a bank is kind of indirect financing. You are financing people, companies, firms go to banks to borrow, workers go to banks to borrow. They take the money that you have saved, individuals have saved, without necessarily knowing the providers of that money. So that kind of segment of the financial market is known as what? Is kind of indirect kind of what? Finance, right? Indirect. So here we have a lot of financial intermediaries in the indirect. We have a lot of financial commercial banks, insurance companies, mutual fund, right? Companies, they are all there. Mutual fund, if you go and buy this, they take your money. But you have to understand that the money is not sitting with them. Whatever you provide to in the mutual fund is not sitting with the institution. They also, institutions and other firms take the money from the banks. So the mutual fund now, the focus on mutual fund now, right? The mutual fund on your behalf take the money and invest elsewhere in other institutions, corporations, and other firms, right? They invest on your behalf. When you go and invest in a mutual fund, I believe some of you are investing in a mutual fund. Yes, some of you are also have the opposite. You invest in a mutual fund company. They mobilize everything and invest on your behalf. Where do they invest? They invest in other corporations or entities that you do not know, right? You do not know. All that at the end of the day, at the year, they come and really sum everything, the returns and everything, the profit and everything, they share among the mutual fund investors. So we can consider even mutual fund as, say, institutions as even intermediaries. Yes.
Another financial institution. I'm not saying stockbrokers. How can you classify stockbrokers to?
Okay.
I hope you are getting my question.
Yeah, I'm getting it. We even come with there are brokers there. The role of brokers. Sorry. Yes. Are you in the broker field or is working for a broker?
I have a small banking background.
Yeah, actually, you have brokers, and it's in my presentation. We have brokers in there. The brokers actually serve as institutions that actually they arrange for buying and selling of financial instruments. That is purely their work. We have even dealers. I'll come to that. They have a section in that. In the market, brokers, they have dealers, right? And we have broker firm. For them, they find buyers for sellers in the market and charge a fee, right? So if you want to sell any financial or instrument, definitely you may not know those who are also ready to buy. So the brokerage firms will facilitate. In fact, it is a firm, a part of or institution that is part of the market, the financial system. They actually train people. And after that, people come to them and they place orders, or investors place orders, right, with them. And they take note of this, maybe have a register for those that place orders. That is those who are willing to buy or sell. And then they will look for them. And because it's an institution, the business that they are doing, if you go there, for instance, you want to sell, perhaps somebody have also come there and they already really have also registered their interest in buying an instrument, or let's say a share, or say a bond of a particular company. They all have the list, those who are willing to buy and those who are willing to sell. So all that they do is that they connect the two of you to negotiate. Purely, if you are to look at that, they connect the two of you, the seller and the buyer. So they will identify, if you're a seller, they will identify a buyer for you. And between the two of you, negotiate for the right price, right? And they do that one for a fee. Is that okay?
Yes.
Yeah. So they do not actually hold instruments for a purely broker firm. No. It's just like, we have these guru guys that you have term in some of these institutions, right? You go there and then they stand ready to help you find whatever you want to sell. And after that, you charge them something, isn't it? The guru guys.
Like agents.
You want to buy agents. You want to buy things. You do not, for instance, do not know where specifically that item is. And even when you want to go and license your car, license of it, they are there, parts of it, they are there, right? Try to show you that, oh, we know this, we can facilitate this for you. This, that, this is where you have to go, that. And then they'll do that and help you find the office to go. And then after that, I mean, you have to dash them something. Similar, let me see, they are not the same, similar to the work of a brokerage firm in the financial market. So the brokerage firms, they are institutions licensed and registered, right? And then their work is to find buyers for sellers or sellers for buyers. That is their work. Is that okay? They are not allowed to take deposits. They are not allowed to take or store financial instrument on behalf of, no. Is that okay?
Yes, sir.
Okay, good. So we have this structure where we have in the financial market, we have the direct, okay? Normally, the direct occurs in the capital market. We'll come to that. And then in the indirect there. So who are the participants in the market? We have the main participant, the savers. Theoretically, or in principle, the savers are the lenders. We recognize them as the lenders. So that's why we have lended savers system here. They comprise the individuals, I and you, right? Having our savings in the banks and mutual funds, buy insurance and other things. These funds, payments, annuity that we pay flow, there are funds that flow and to the financial intermediaries. So we have the household are individuals, businesses, government, and as I said, the market has been internationalized, so we have foreigners also participating. So they are the lenders because they have their savings with the financial intermediaries or funds there. So the funds are with the financial intermediaries. We in the other side of it, the funds that we see to be with the intermediary will flow to the same those who want to borrow, the borrowers. They borrow to spend, okay, on their investment or on other things, right? It's the same individuals. We have individuals, the household, that's household. Government are part of the market participant to borrow, they borrow, right? Our businesses also come and borrow. So they can go directly to the financial intermediaries, right? Like banks, mutual fund, and so forth and so other institutions that we have, and take your money there. So you do not know, but these institutions stand in as intermediaries to connect that. So that is that. But we in the direct finance, actually, it is where it occurs actually in the capital market, bond market, and then the equity market. So individuals choose these same individuals, the money, they come to the financial market and straight away they buy shares. Okay, they buy shares from companies, firms. Other firms also buy other firms' shares. Other firms also say lend money to other firms or other companies. Yes. So governments and other financial institutions, they also lend money. So government can also lend money to other governments. There are sovereign borrowing that occurs in the market. Okay, there are sovereign borrowing at the country level. They borrow. Now, governments can lend to other government, or other states can lend to other states. Okay, in that order. So in this, when they come to the capital market, they either buy shares or buy bonds. And there I said that you really have the right to direct where your money should go by selecting the company that you want to invest in. That choice is your own. Even though you may have investment advisors in there, brokerage firms, whatever that we are saying in there, but you have to decide which firm that you want to invest, the particular firm that is your own choice, and your money goes straight away to that firm, right? So that becomes a direct finance. So that is how the market has been structured. Okay, so direct and indirect. So I have expanded it here by giving the institutions and all those things that the dynamics that occur in the market. Now, particularly if you look at the structure of the financial system in Ghana, this is how it is, right? If you look at the structure of our financial market, That is how it is, right? We have the regulators sitting on top, the regulatory institutions. Okay. For instance, Bank of Ghana responsible for the deposit taking and some non-deposit taking institutions. The central bank. So the central banks regulate. They have oversight responsibility over some deposit taking institutions and all deposit taking institutions. Okay. So we have Security and Exchange Commission also having a supervisory and regulatory oversight over Ghana Stock Exchange, brokerage firms, and then investment management companies. We have the National Insurance as a regulator responsible for the regulation of insurance companies, insurance brokers, and reinsurance companies. And then the National Pensions Regulatory Authority, okay, also having oversight responsibility over SNETs, other occupational pension firms or institutions in Ghana, and other private pension schemes. Okay, so if you come to the institutions under the central bank, this case Bank of Ghana, we classify them as deposit taking institutions and non-deposit taking institutions. And if you look at the structure of the deposit taking, you have universal banks. Okay, you have universal banks. In those days, in the past, we used to have, even in the banking industry, several segmentations or sessions or types of banks: commercial, investment bank, cooperative, a lot. Okay, but these days, there are licenses, and in each kind of operation that you want to do, if you want to go to commercial, the licenses used to be different. If you want to go into investment banking, the licenses will be different. I'll talk about them later on. What is commercial banking and investment banking when deal with the institutions, right? So, but have been brought back and together, and now they are all operating with a universal banking license. Said that if you are issuing the license, you have the capacity, then you can operate other investments, commercial, merchant banking, and other things. So you have the deposit taking. So they are, when talk about they have been licensed to take deposit from individuals, household, government, firms, and other things. So they have been given the rights. And they have to meet certain requirements before you are given that. And then we have the rural banks also there that were supposed to operate in the rural areas to serve the rural community, but they are even in the cities. Yeah, so they don't know whether they are even rural banks or not, right? So they were restricted to operate in those days in the rural community to serve a unique function, right? But they have also fought to come into the city, and they're allowed to permit to operate. But some of their rules are limited. Their functions, things that they can do, are limited. For instance, they cannot engage in foreign exchange activities. If you go to rural bank, you cannot buy dollars there. Okay, some of their these things they have been limited or restricted. You have savings and loans, and then you have microfinance institutions. They are allowed to take deposits. Now, take note: not all microfinance institutions are allowed to take deposits, right? Unless they have they meet certain requirements and they meet the capital adequacy requirements, right? Because taking deposits, if you're not well capitalized, that is, if the equity supporting the company, the shareholders' funds, if they are not adequate, now we expose deposited to risk, right? So you remember, I don't want to really, because some of these things are legal issues now, but let me cite this. Remember Men's Gold case, isn't it? Do you remember the Men's Gold case?
Yes, sir.
Yeah, this is a case study. We can take it as a case study out. Yes. Bank of Ghana came and stopped its operations. And but they are also arguing that Bank of Ghana really do not have rights, isn't it, to stop them. But one argument is that you are taking them, you are taking deposits. The mechanisms or the modus operandi of the institution, Bank of Ghana saw it as an institution taking deposits. But they argue that they are not taking deposits. So later on, they argue that people bring their gold, their financial this thing there, and then I think, if I'm right, they do that transaction on their behalf or exchange it or whatever. Okay. And national, that is Security and Exchange Commission also have to come in and saw some of the aspects falling under their listing. And therefore, you also require license from them. I think the argument is out there and the matter is in court for them to say, so we may not go into some of the details there. But if you are taking deposits, then you also have to make known your own capital to absorb losses on behalf of depositors, assuming that you lend the money. When the banks lend the money, the expectation that some of them will be unrecoverable. There will be losses. But these are deposit money that have been lent out there in the form of loans. And you need to go and the firm have to recover, the banking institution have to recover all of them on behalf of the service. If you have a reckless banking institution, they may not, or they may give loans anyhow, and it has happened. It has happened. Some of the banks are just merely Ponzi schemes. They set up, collect deposits, and the owners use the deposits to finance their own investment activities. They set up, knowing that deposit will deposit their funds there, and they will have access to deposit funds to go and do their own investments in somewhere, buy lands, and then invest in houses. I mean, mobilize these funds for their self-interest. It happened there. Historically has happened, and it won't happen. So that's why they are highly regulated. But I will not talk about regulation now. So for microfinance, some of them can take deposits if they are adequately capitalized and central bank or Bank of Ghana is satisfied with it. Then you can be given a license to the but some of the microfinance institutions you will never allow to take deposits. All that you have to do is to learn. That is your work. Learn. If you have money, you can lend to others, but you can't take deposit from others. Now, it makes sense. If you don't meet certain requirement, you can lend your own money and bear the risk. And bear the risk on your own. But the central bank will not allow you to meet certain requirement, allow you to take deposits and you deposits and lend it out there and create risk for the depositors. No. So we have non-deposit taking institutions that we have them as finance houses and have leasing. Yes.
Doc, please, I want to ask a question.
Yeah.
The deposit that the Bank of Ghana takes from this central bank, like these universal banks, let's just say maybe you need to have a minimum of 4 million Ghana cedis. Do they take in cash or some of their assets has to be together to get that 4 million Ghana cedis?
Yeah, purely you are coming to deal with cash. Banking system is purely cash. So we are not interested, the Bank of Ghana is not interested in physical assets, lands and all those things. And if you study banking, even when a bank is taking collateral, in fact, purely, banks should not be interested in even physical or collateral. The collateral that even individual provides serve as just a psychological, purely in economics and finance, right? A psychological factor to cause the borrower to pay. Now, banking deals with cash, liquidity, right? Liquidity.
Yes.
And therefore, the amount that they have to provide should be in the form of cash.
Okay.
To provide to support losses, to absorb losses. Every year, banks will suffer losses. Every year. When you are doing lending activity, you will suffer losses. Moral hazards are in the market. Not everybody generally will come and borrow and pay, right? Some will generally die. Some individual will come and borrow, they will not pay. They will borrow and travel. So these are knowledge out there, right? That is established in theory, and therefore banks are supposed to have enough cash to absorb all those expected losses on time, so that they can replace deposit funds when deposited. Yeah. When you go to a bank, assuming Bank of Ghana allow other assets, physical assets and other things, and you go to a bank, you want to withdraw. The bank says, wait, we are going to sell our land. We don't have cash today. Wait, we have a lot of lands or houses there, and then we want to sell. When we get buyers, we come and then we receive cash. We come and pay you. You are cash. Sorry, you are say check. Will you be happy?
No, please.
So you see the sense in getting the cash available.
Very well said.
Yeah, thank you very much. So the market is classified also in the debt market and equity market, structured or segmented in debt and equity market. Okay, debt and equity market. Can anybody tell me the difference between equity market and debt market? Can we differentiate between debt market and equity market? What is equity in the first place?
Equity refers to ownership rights in a company.
Yeah, ownership rights in a company. Good. And what are some of the things that you can describe about equity? If you are owner of a company, what are some of the claims? What are you entitled to?
Entitled to dividend.
Dividend.
Yeah, dividend.
And also to have the voting rights at annual general meetings, right?
You have the right to make decisions, right? By voting. Right? By voting. Your decision will manifest in your voting, right? So I give you right to vote. Okay. But what about debt? Assuming that you have always invested of these two opportunities, either to supply your money in the form of say lending, right? Or you supply the money in the form of buying a share and becoming an owner of a company. These are the two things. If you have excess funds, you can supply it by lending, or you can supply it by buying a stake in a firm to become an owner. Good. Now, we have said some of the things that you're entitled to. Dividend when it comes to equity.
Sir.
Yes, please.
Yes, sir. It's time for break.
Break. Okay. Let me finish this slide and quickly we go, right?
Okay, sir.
Your class rep is working. He's very active in the classroom. We talk about active participant, active what do you call it? Investors.
Participants.
Yeah. So here, we have in equity, you become owner of a firm. Now, owner of a firm, you are now entitled to interest. You can't charge your own company an interest, can you? If you are running your own business, you cannot say that this business I'm doing, I've supplied my money, I'm financing it with my own money. If you assuming take yourself as an individual owning a business, a small business, and you have financed it even with your own salary, you cannot say that you're entitled, you will charge your company the same distance, unless of course you deem in a class as, okay, I've given us in the form of a loan. So you are not entitled to, if you're a shareholder, purely you receive dividend. That you have to wait till the company generates good profit, net profits, positive gains or profits, the nets, and then you distribute or share among yourself. Right? That becomes your dividend. That is what dividend is. It is the amount that received after the net profits is proportionally shared among the owners of the firm. So you're entitled to the dividend. Okay. And then, yes, Ima.
Yes, sorry for my background. It is raining here heavy. I just want to understand because we said that owner of a company, we're entitled to income. What of profit?
Yeah. The profit is what is shared, and we call it dividends. Are you getting it? Technically, we call it dividend. It is the net profit that is shared among the owners. If you are lucky, you are the only owner, everything comes to you, and it will not be shared. But you have several owners of the firm. There's a way that you have to share it proportionally based on your investment. Like in any investment, so if you have 2 or 3, let's assume small firm, you have 2 or 3 individuals there owning the business. After the declaration of the net profits, what do? You may decide to, I'm saying you may decide to share, or you may decide to retain it, reinvest in the business. But if you decide to share it, what comes to you, the profit that comes to you out of the profit is what's called the dividend. Is that okay? Is that okay?
Yes, sir.
Yes, sir.
Yeah, that is what they call the dividend. Good. And so you have ownership claim, right, in the business. You serve as an owner, right? In the event of anything, if you want to liquidate the company, sell the assets of the company, you are entitled to that. Okay, you're entitled to it. Another form of where you can also be, when you are this thing is the shares is trading on the stock market, you can get what is called a capital gain. The price may appreciate, may appreciate. When the price goes up, it is a gain for your capital gain. So one of the things that happens that shareholder benefits is also capital gain, right? Where the price of a share is trading can really increase. When it increase, assuming about the 2 cedis per share and then increase to say 5 cedis per share, even though you have, this is not, there has been appreciation. So you have gain from the appreciation, right? And that also is called the capital gain. You have gain from it. That is different from dividend. So if you're a shareholder, you can really benefit from capital gain and get also dividends from the company, right? But note that the dividend in some cases is not always every year or every time that you'll be giving. The directors of the company together with them decide to reinvest the profit into the business. These are corporate finance issues. So let me leave it there. And so if you're equity holder, we say that you are residual claimant. When everyone is paid, every supplier of fund is paid, then that you can be paid. So you are residual. You receive only residue of the thing. Residue means what is remaining, isn't it?
Yes.
Yeah. So assuming there's a challenge, for instance, the company faces a challenge, it's liquidated. When the company is liquidated quickly, every debt supplier or debt holder in the business will have to be paid first. The debt holders in the liquidation process is superior. So we call they have seniority over this thing. So they have to pay. So let me take a break. We come back to this slide, right? And then we continue. Otherwise, the class rep, active class rep, and we'll talk about the debt issues. Thank you very much.
Right,
Thank you.
Thank you, Doc.
Thank you, sir.
30 minutes, right?
Are we back or it's not time?
It's time, sir. We are back.
Okay. There's a class rep there. Class rep, are you there?
Hello, sir.
Yeah. Can we continue?
It's time, please. Yes, we can.
Okay, so let's look at, please. Are we recording? I forgot to. I should record and
No,
give you the
no, it's
recording.
being recorded.
Sorry.
It's being recorded there.
Yes.
Okay. All right, fine. Okay, so let's look at, we're looking at the equity. So we have seen that we can classify the market into equity. Either you supply, suppliers of funds will quickly supply funds by becoming a shareholder. And we look at the characteristics, some of the benefits that is associated with that. And we say that if you're a shareholder, you are residual claimant in the sense that even when it comes to the before the net gains, the net gain is obtained or declared. If you look at the financial statement, debt holders have to be paid first. Anybody interest have to be paid first, right? If you look at even the structure of legally how things are done, as far as financial statement even concerning the preparation, if you look at it, you can see straight away that always interest is seen as a cost first and deducted before you arrive at the net profit, right? Before you arrive at profit. So when you a supplier, for instance, is a supplier of funds, right? Invest in the form of a share and become a shareholder. The interest, those who supply funds in the form of lending to the firm, really their interest have to be paid first. When you invest in a debt form or you lend, the investor, the debt investor, or whoever is holding that debt investment is entitled to interest, right? It's entitled to interest, but always interest is paid first before the net profit is declared, right? So interest payment even superior to the payment of dividend, right? And when the company also, the assets of the company is liquidated, if it's liquidated, especially when the company is in trouble and the assets are liquidated, if you're a shareholder, before you can receive anything, all the debt providers or claimants in the company will have to be paid. So in finance, we say that the debt providers are senior, right? Senior to that of shareholders when it comes to liquidation of assets and the assets are being shared. All debt holders have to be paid or have to be settled before, if anything left is left, you have to, then it's shared among the shareholder. That's why we consider a residual claimant. Now, so in the markets, as I said, we can lend, fund, or invest as shareholders. So the debt market is the market where funds are lent in the form of loans, right, to borrowers. And we have debt instruments that can also be traded. If an investor has said you are entitled to what? Interest. And then when the debt matures, the maturity period, the repayment of the principal is done, right? But if you're a shareholder, you are not going to receive any repayment of your funds that you invest in the company. If you want to sell your shares, then you can sell to a potential or interested shareholder, right? But in terms of debt, if you provide debt, you are entitled to repayment of the principal that you offered in the form of loan, and then entitled to also interest. Now, in the debt market, purely, they can be considered as short-term or long-term, and if like the intermediate term. So three aspect or component or say segment is short-term, normally considered as a money market. Later I'll look at the market. The short-term is considered the money market, right? All financial terms and agreement, they are under 1 year, less than 1 year, right? Less than 1 year. All the financial agreements, when it comes to investment, like they are basically guided by agreement. So you look at the time of maturity when the agreement was expired or settlement, what do you call prepayment will be done. Okay, either it can be classified long-term, short-term, or intermediate. So if the agreement guiding the lending or the loan is under 1 year, then we say that it is what? A short-term. Normally, we can classify it also as the money market. Now, the debt market, we can also have it to be a long-term if the expiration or the maturity of the agreement or the loan is more than 10 years. Okay, more than 10 years. Then we say that it is in under the long-term debt market, right? It falls within the long-term market. Now, between 1 year and 10 years, we classify it as intermediate term market. So that is another classification and structure of the market. Now, in classify it, as I said, is another form we have. Look at it, debt market and equity based on the nature of claim, whether you're entitled to interest or dividend, and whether the claim that you have is said that the amount that you initially invest will be repaid to you or not. Now, if repayment will be done, then it's a debt instrument, or then it occurs in the debt market when repayment will be done. But in the equity market, no repayment is done. Okay, the amount that you use to fund the company, if it's an equity form, no repayment is done. So based on the claim, we can have debt market, equity market, and then we can have money market and capital market. For instance, in the previous lectures, I said that for the short term, any instrument that mature agreement that mature under 1 year is seen as short term, and that also falls under what is called the money market. If a long term, then we have what is called the capital market. So the market can be classified in form of money market or capital based on the maturity of the instrument or the claim that you have, based on the maturity of the claim that you're entitled to. Okay, if it's long term, then it's seen as a capital market. So equity market, equity, equity does not mature, right? In equity, when you invest in a share, in a company share, it has no maturity period. So it's also seen as it comes under capital market, right? And then the debt instruments that are in the long term form part of the capital market. So if you want to talk about the capital market, you can talk first of all about equity. You talk about long-term debt instrument that comes in there. All right, and then we have the primary and the secondary market based on the seasoning of the claim, right? Now, in the primary market, companies issue this financial instrument either to borrow or to invite equity holders, right, into the business. Now, at the issuance of the instrument, when the issuance of the instrument is done in the first time, investors buy either shares or, say, debt instrument in the form of bond. Investors buy that. Okay. Now, when the investor buys such instruments, the money or the funds that they supply goes to the company that issued the instrument at the first time. At the first time. For instance, when MTN issued their shares, it went to the capital market to sell shares or get listed on the Ghana Stock Exchange. At the time when they issue their shares, investors will go and buy. When they buy the shares, the money will go into MTN's account. It goes into the MTN account. So at the time, those who bought all the money that they paid in receipt of the shareholdings or stake in the business, they paid the money directly into MTN's account through an investment bank. We'll come to that. But for now, let's assume that the money goes straight to MTN. Now, so the money right now, those who bought the shares at the first time that they issue the shares, we are saying that the proceeds or whatever, the money will go, the fund will go into MTN shares in receipt of the stake or shares in the company. Now, the existing shareholders, those who bought the shares, now we call them existing shareholders in MTN. Some of them really might be interested in selling their shares now in order to get cash for whatever purpose. If the existing shareholders sell the shares, for instance, if assuming that Joyce is an existing shareholder and sells his holding in MTN now to, say, Asari, okay, to Asari or to Tete, where do you think that Tete's payment will go?
It comes to me.
Will come to you, right?
Yeah.
Good. So this time, it will come to you, the payment will be paid into the account of Joyce, but not in MTN, right? Joyce owes the shares now. Now, this is where the market is classified into primary and secondary. Primary and secondary. Now, when a share is issued at the first time and is acquired or purchased by investors, we say that the shares has been issued in the primary market, has occurred or issued in the primary market. When a share is issued for the first time or was issued and purchased for the first time, that share, we say that the trading or the activity has occurred in the primary market. So the primary market is a part of or a segment of the financial market where financial instrument or assets are issued for the first time and is traded, right? Or issued for the first time and investor buys it. The key thing is that it is issued at the first time, investor buys it, and the payment is made into the account, or the fund flow into the account of the issuer. The issuer in this case is the company that issued it. Now, whoever buys it becomes an existing holder of the issues or is a holder of the financial assets. The person can hold it to a certain time and may decide to sell it for cash. If the person sells it, now when he sells it, existing shareholder sells its asset to another investor. We say that it has occurred in the secondary market. And the funds, the payment goes to the existing shareholder, not the company that issued it for the first time. Is that clear?
Yes, sir.
Yeah.
Yes,
So,
sir.
yeah. So secondary market is the market where an existing instrument or asset are sold. Right? Sold. But the first issuance occur at the primary. So these are the classification that we have. Now in the market, we can have, I think I've explained this in the next slide, so you'll get it. It's secondary and this, how do you call it? Okay, primary market is where the new security that are issued are sold to initial buyers, right? That is a, so buyers buy it. And good evening. Today, if, for instance, MTN can still issue, they may have another shares that they have shelved, and they may issue it, another set of anybody that buys it. Once it is the company that have issued a new set of, say, shares, you buy it. Now that shares trading will at that instant will occur at the primary market, even though they have already sold another one, but there are some that have shared, existing shares, some shares that have shared, let me put in that, this technology, but they can bring it into the market and sell. When they issue it and they are selling it, once coming from the company, we say that it takes place at the primary market. Okay, primary market. And then normally investment banks are involved. Or we talk about investment banking here. They play a role, right, to sell and market issues, right? The securities. That is one of their role. If any investment, any companies are issuing any new security or shares, they have to be guided by investment banks, right? Like Data Bank, for instance. There are a lot that we have in Ghana, right? Data Bank, for instance, that comes into my mind. They are investment bank, okay? So they have special role to play. Investment bankers lead companies to sell or issue shares. They help them to evaluate the shares and price it based on information and the value of the company. They market the shares on their behalf, right? Find potential buyers for them. So they normally go on roadshow on behalf of the company that is issuing the shares. When we say go on roadshow, means that they will go and market it, right? Find potential buyers, make presentations like any seller. For instance, if you have marketers, right, of a particular product, the company designed a product, you need marketers to go and present it out there for individuals to develop interest in it. And so when that is the product market, we come to the financial market, basically are the investment bankers. They help to evaluate, they lead to market it, find potential, and you know what entails in marketing. You need to, if you are selling a product, you need to know the characteristics, the qualities of it, and present it to convince the potential buyers. And so, same when it comes to the financial market, that is the work of investment bankers. So they lead companies to issue shares, bonds, or debt instruments, right? Find buyers for them. So they'll be marketing it, presenting it, giving the characteristics, why this of the company and all those things, they have to present it on in the market. In fact, if even a government or a company want to issue a bond or shares, you can't do that when you don't have investment bankers leading you. That is the law. That is the position in the market. The belief is that investment bankers are well trained, they are sophisticated and they understand the dynamics in the market, but you may not. It's just like in the medical or pharmaceutical field. There are certain things that now, if certain things are not being prescribed for you, drugs or medicine, you walk into a shop, pharmaceutical shop, without it will never be sold to you. It's regulated, it's law. Certain things have to be prescribed by the experts. So if in the market also is to ensure that whoever comes to the market to come and sell, you are led by experts. It's part of to ensure market efficiency, to ensure that those who come to the market, really, if you are issuing it, you'll be guided and not fall into troubles. It is good, but it can be dangerous when it's not well administered, or it's the prescription, whatever is given to whatever you have to take is right. It can kill you. Okay, so fund is good. Is everybody knows that the market understand, or we know that you need funds, company need funds, government needs funds to embark on a particular project, to finish a particular project, whatever. You need the market understand that, experts, so that you don't get the funds and then or you don't come and people you misprice things there. Okay, so that is us. So the investment bank, that's their rule. Ghana government may have finance minister. Ghana government may want to go to the international market to go and borrow. If you don't have investment bank, if you are not led, your finance minister will not cannot go there and say that I am finance person, so I am coming to lead my government to raise funds for my government or for my country. It's not allowed. So they are professional institutions that help business. And that's why I say they lead them this thing and underwrite the offerings, things that they do. If we are the underwriters or the investment bank serve as underwriters, helping to value so that the right price can be determined. They even play a role in guaranteeing the price in the market. How do they do that? Now, when they lead, after going for the roadshow advertising and getting this thing, either they have a contract with the issuing company that they will, any leftover of the securities or the issues, they will guarantee it purchase. They will buy and hold it. Okay. So for instance, MTN issued 1,000, say, shares. They bring it to the market, only say 600 of the 1,000 is purchase, left with 400. In certain cases, based on the agreement that the investment bank has with it, they will buy all the 400 left and keep it in the for us and serve as a dealer. Keep it. Now, what are they doing? They are helping to guarantee the price, because left to the MTN, they issued 1,000 shares and they want to raise a certain amount. Okay, certain amount. Maybe the 1,000 shares equivalent to, let's say, 10 billion. That is what they have targeted, 10 billion Ghana cedis or dollars. And that is what they think that it will help them finish their projects. Okay. Now, but they come to the market, they are able to sell only 600, equivalent to 6 billion. The 4 billion is left. How can they? If you don't take care, MTN, like in any market, when there's excess supply, what happens? Your basic economics. Excess supply of goods, what happened?
The price will drop.
Surplus.
Price will
the price will drop.
Yeah. So that is why also investment bankers are also important in this market. They will guarantee to buy it so that the market, the value of the shares will be maintained. Otherwise, if they don't do that, the early buyers will lose. They price the share, each share as say 2 cedis. Now, because they have supply in excess and buyers are not buying it, investors are not buying it, they may be tempted to reduce it. Meanwhile, the early buyers are bought at 2 cedis. You don't take it, they may be tempted to sell it even at, if they are desperate, sell it at, let's say, 1 cedi 50% or even 1 cedi per share. So, in fact, in the market, it is regulated to prevent some of these things. And that's why you need investment banking. That's the role of investment banking. They help corporations, government to raise funds. And they have specific rules, and some of them are the ones I have explained. Okay. So the secondary market is where previously sold security, right? It's also exchanged, or previously bought security is sold. As I explained earlier on. a previous or existing holding is exchanged with another investor. Okay, that is that. Now let me go back to the slide here. And the markets, based on the time of delivery of an instrument or a security, based on the time or actual time at which the security or the financial instrument will be delivered. We can classify it as cash or spot market, or the forward or the futures market. So in the financial market, we have what is called the spot market. The spot market is the same thing as the cash market. And then we have the forward or the futures market. Okay. In fact, I've explained all them, but let me explain it as when you get the material, then that is it. When we say that you bought or you have purchased something cash, what does it mean? Or purchase something on the spot. Mm-hmm. And then you have what? Yes.
I was saying you bought an item and then you get cash on the spot.
Mm-hmm. So you bought it, and then you pay it instantly to receive the underlying or the item that you bought. So you go to where they sell the shoe. You negotiate for the price. They say that it's 100 cedis. You pay 100 cedis, and the shoe seller instantly gives you the shoe. So there's no delay payment or delayed delivery of the item. Okay. So same in the financial market. Financial instrument or asset can be bought. You know, buying and selling are basically agreements. They are guided by the principle of what? Law. Agreements. So you buy the item, either you agree to pay today or instantly and receive the item, or you can negotiate and get a contract. And based on the contract, right, you spell out that the items will be delivered to you maybe the following day. And then payment will also be done the next day. This is not a spot market. Though you have an instrument, that is a contract, indicating that you agree to buy and the seller agrees to sell to you. But no, payments, you agree that the payment should be done the next day. And then the seller says, okay, I'll also deliver the item the next day. This is not a spot or cash market. Though there has been an acquisition or there has been a trading, right? Trading has occurred. Having the contract itself is another kind of trading. But this is a delayed delivery and payment. So in that market, we call it forward, where the delivery of the assets, the financial assets, will be done at a later date. Or the payment will be done at a later date. So in the market, we have the forward and the futures market. Okay. In the forward market is similar to the futures, the same thing, right? But the futures is said that they are standardized, the trading that occurs there. If I would deal with this market in the course of time, maybe the subsequent lectures, we devote my time for that market because it's a market that is special and unique in its own. So for the forward market, they are not standardized. The agreements and the quantity or the volume that can be purchased is not standardized, it's not set. Individual or investors can, on peer-to-peer, agreed on their own. Okay, on their own. It is less regulated. So person to person or P2P can agree and negotiate the volume and the price and then set their own delivery times. That is the nature of the forward market. But the futures, now this is not future, it is futures. It is a name. So it is a noun. No, every place, every market has its own jargons or language. So this is a futures market. The future market, the market and everything is standardized. They are all standardized, unlike the forward market. The volume or the minimum amount that you can purchase is set. And this can be even the currency market. The forward and then the futures can be in the currency market normally, right? It can also be in the equity and then the bond market, okay? The bond market. Now, when we talk about the bond market, the same as the debt market, just that the bond market are long-term. So when we talk about the long-term market, then we are referring to what the bond market. The bond is debt instrument. Or when we talk about the bond market, it's a market, financial market, where long-term debt assets are traded. That is all. So this bond, when we talk about bond, you know, we have this bond terms in our place of work where we say you are bonded to do that. No. But it's another term in the financial market. It is, when we talk about bond market, is the market, the financial market where long-term debt instruments are traded. So I mentioned that when it comes to the futures market, we can have bond, shares, currencies trading there. And the deliveries are specified. Even in the future market, the minimum amount, if you are buying a currency, for instance, in dollars, the minimum can be, say, $500,000. In say, if it comes to the bond market, they say that the minimum that you can buy there, maybe say 20 bonds or 100 bonds. The British pound say 125,000. So it is standard set. The volumes are set, and the prices are also traded, shown on exchanges. But as for the forward, individuals can meet and agree. For instance, if you want to buy, say, dollars from a friend, you can go and negotiate and buy it from the friend and say that, and the friend, you can negotiate that maybe you need the dollar, not today, but you need it, you need it the next 3 months, where you may need it for, say, payment of a particular item, right? But you go and negotiate with a friend or go to the bank. In fact, it occurs in the bank. Forward also is in the banking sector, right? Yeah, we'll talk about it when we move on to over-the-counter markets, and then we'll talk, then the exchanges. So you can go to the bank and have an agreement with the bank and say that in the next month, you may buy some, say you need about $10,000 for your business. And the bank will agree with you if they like, and then set the price at which they will sell it to you when you go to the bank. So you walk into the bank or you walk to your friend, you set the price today, but the actual payment or exchange of, say, the cedi for the dollar will take place maybe next month. But the price that you buy it or you pay will be agreed at the time that you went for the agreement. So if today you go to the bank or you walk to the friend will agree with you. Okay, next month. Now, what is the dollar rate today? Does anybody have an idea? The dollar rate today, I've not checked it. Is what?
11
I'm told that it's going up a bit.
$1 is 11
10.99.
Almost 11.
10.99.
10.99.
Okay, whatever it is. So in the spot market today, if you go and you want to, say, buy $1, right? That is how much the cedi that equivalent that you pay, right? Instantly you pay and you get your $1 at 10.99 to say, or whatever it is, instantly. So that is the spots. On the other side of it, you can negotiate with a party, say a bank or any other individual, and say that though it is 10.99, and if you like, you agree, you pay, say, 9.5 next month. But the 9.5, you agree today. Or you say that you pay 13 cedis per dollar next month. Is agreement that you have made today. But the cedi for the dollar will not be exchanged today. It's So one thing about the forward and the futures market is that all the price that you pay is known today, even if the delivery will occur in the future, right? And this market, the forward and the future is there. We have even, when you go to the alternative market, like the commodity where gold, silver, cocoa, I heard that now Ghana cocoa is, they have reduced the price. We don't have even, what do you call it, buyers to buy now. So it is out there in the news, right? That is where those, if people had forecasted well and anticipated it, right? And that's why you need financial experts in some of this area. You don't go, excuse me, I may be affecting other things, so let me drop it. In these areas, you need people who really can do forecasting, not all people who can just talk. Not people, but here, because of politics. I mean, in finance and in commodity market, gold and all those things, I mean, you need expert there to forecast the trend and the market that is going based on data so that we can determine the price. And if there's any need, you hedge at that time. And so you agreed on either on the futures market or on the forward market and get the buyers to arrange and guarantee a price. I mean, these are there. These theories and financial knowledge are there. But what do we see now? We are saying that we are not having buyers. Cocoa, so now cocoa, what do you call it? Well, what do you call it? Farmers. I mean, suddenly they are there. The announcement comes. Hey, bash. We have reduced cocoa price by about 50%. I'm saying like that. It's a shock. So that is why we are saying that we in the introduction part, when looking at the talking about the core description, we talk about learning the theories and then apply it in the real world when we are faced with their challenges. Okay. Let me end my this thing. I don't want to record Ghana. So yes, Ima.
Yes. My concern here is about the price.
Mm-hmm.
About the kind of forward buying. So when you want to buy in the future and then the forward, there's probability of price change. In that case, when it happens, what's coming to? Because when you are agreeing on the future and then the forward, the price will be affected. So in that case,
if I got you well, you said that the price is uncertain, so it might change, isn't it?
Yes.
Oh, okay, good.
So in that case, what will you do? Because you spoke about the future and the forward. And so because if I may understand,
so you fixed your position already. Yeah, so already you have taken it, you fixed your position. We'll talk about that. So I agree with you to a certain extent, but this is the market itself. We expect market participants to be rational. There's a theory guiding this. I mean, before we determine the forward market, interest rate comes in. There's a model. You don't go say that and then they agree with that knowledge. That's why in the initial stage in the market, we have investment advisors in the market. We have to forward this. You know, there's this triangular arrangement between, even if exchange rates, between interest rate and exchange rates. Okay? There's a relation between exchange rates and interest rates.
Yes.
Okay? And even in the commodity market, interest rate affects it. Okay? Interest rate affect inflation. The three factors goes. So in the determination of what the forward price will be, you need expert to forecast it. As you move on, we appreciate how prices are done. I hope that we'll get time to deal with forward pricing. So there's a model of pricing it. So when you are going to do this, you need to be guided by experts based on the direction of the interest rates, based on the current spot price, based on inflation. Then we forecast. Now, inflation is just expectation of what prices will be in the future. So if you say inflation rate even is 10%, it doesn't mean that today all items have been, no, it's expected price. Average price of goods and services, our price will change. So it's expected. Now, so in fact, interest rate, inflation, exchange rate are linked. And that's why if you are controlling inflation, it affects exchange rates. What is inflation? The price of goods and services related to other countries. That is okay. That is exchange rates. Interest rates affects exchange rates. Now, if investor expects interest rates to go down, the expectation about interest rate rationally, if it is to fall, right? Investors expect that they will have to look for another place, let me say, another country economy to invest there. So as interest rates coming down, sometimes investors will divert their funds into other economy where they can earn higher rates. And as they take their money from your country, for instance, dollar from your country, your dollar will be, the dollar will be what? Appreciating, because they will have to. Or even if in the city, they divert the city investment into, say, Cote d'Ivoire, where they can earn more this thing. They will be changing the city for more dollar or more safer. And the safer will be appreciating while the city will be depreciating. So the market is, the dynamics is based on expectations of these three items. So there's a model, there's a formula which the three are in there, where interest rates, inflation, and other things can help us to forecast. In fact, in finance, it is forecasting. Unlike accounting, finance is basically on forecasting, using information or data to forecast what will happen. And so the expert there. So we understand that price may change, but if you get your data right, the deviation, the next month or that you forecast, if you did the forecast well, unless of course there's a unique event in the world or in the economy that which can bring a substantial deviation, and not normally doesn't happen. In fact, when you study data, it is infrequent to experience a special break like COVID. Now, how many times have the world experienced COVID? For that one, those who forecasted things, I mean, when COVID came, that episode crashed everything. So really, all forecasted activities or whatever, they may got it wrong because it was unexpected events. It crashed everything. But data, all things be equal, the future relates to the past, the present, and the past. That's why we study time series. It's a unique thing in finance, right? So you may forecast. You forecast, that's why I forecast. But you forecast based on good data and information, good model. What you are going to, the future price shouldn't be different from the spots on the day what you agreed on. So your agreement will also be backed by certain level of rationality. So we have what is called rational expectation theory or hypothesis in the financial market about pricing of assets, using or utilizing information to price items. And that is what the data comes in. Yes, I agree the price may be different, but it shouldn't be far. But there's options that you can also minimize even after taking that position, right? After taking that position, I'll talk about hedging. And that is where the hedging will come in. You take a long position today to buy an item, but the price may change. Then you take another position called a short position to sell. Now in the market, there are people or investors that always who want to buy things and those who always want to sell things. So our buyers always, we pick one asset. Buyers are there, sellers are there in the market. In any active market, that is what happens. Everybody coming by their own expectation. When you go to bond, Dr. Bright will come in later on when we are going to bond this thing. She will teach you that. And you got to know that there's a model for pricing of bond, model for pricing of shares. There's a model for price of exchange rates. All the financial instruments that are traded, models are there to price them. So if you utilize it and then you get the right data, you should be able to, the price that you forecast shouldn't deviate largely from what you forecasted. Yeah, the deviation can come, but if it is done well, the deviation should be very minimal. That is the science of data called statistics in finance. So the aspect there that people do, they don't consult. And that's how consultants are there. Consultants are there. And so even if you are going to do that and going to trade in this, you consult and just go and pay some fees a bit. When you are sick, you go to see a doctor. So when you're also going to do financial activities, business and other things, see people who have expertise, training theories, and to guide you before you make decisions. So that's why people have set consultancy and other things there. But you know, in Africa, what is consultancy to people? I'm going to do my things. I'll say, go consult. I hope all of us understand.
Yes, sir.
You are foreigners. On go to Sikaka Krano na Ankayam, on
Yes,
Pama
I'm
Espionage
here.
advice. No.
I'm
Do
the
you
only
have
foreigner
foreigners?
here.
Oh, sorry for them. Sorry for that. So, you know, you
Oh.
instead of people going to, yes, please.
I think you are asking whether you have foreigner in the class.
Hello? Yeah.
Yes, I say I'm the only foreigner here.
Yeah, okay. Ture.
Yes.
From Cote d'Ivoire, eh?
No, Gambia.
Gambia, Oaks.
Yes.
Thanks for joining us. Good.
Welcome.
I have to go to Gambia. Maybe go and lecture.
No problem.
I'll get an appointment there.
Oh, okay. That's fine.
Okay, so, good. Now, so I mean, there's science of data and all those things there and there are models that can help us. This thing that we are doing, forward futures, and there's a way that they price it. In the futures market, when you go to the US market, because it's standardized, now the market, there is even when you sit behind you, I hope next week when we meet, I will introduce you to some of these screens and all those things through the net. There are even 3 months, 4 months, 6 months, prices are quoted there. On the screen, if you go, if like the one that meets the data you want to do your listing, you buy and enter into a contract. Now, if you think that is not in your favor, right, after entering into the contract, when you buy financial instruments, say that when you buy anything, I'm going to hedging now, you buy anything today, we expect that price will go up for you. When you buy, for instance, laptop, and you want to trade it, you buy it today with anticipation that the next time or day or month, price will go up for you. It is possible that price will fall. In business, normal business dealing with trading, what do you call it, normal goods. You can buy the item today, but you buy the item with expectation that price either will be the same or will increase for you so that you get profit from it. Price can drop. All right. Price can drop. Okay. Now, if you expect price to drop, what do? You quickly have to sell it. It's the normal thing that we do. If you sense or anticipate or get a signal from any place or news that price of the item, laptop that you bought, laptop price is expected to fall based on the information that you have. If the information is good information, quickly what do? You make an attempt to find a buyer to sell. You have bought it, but you got the news that price is about to fall, which is not being in your favor. You have been exposed to a higher risk. So quickly you come to the market and find a potential buyer, negotiate and sell it. We call it short selling. So there's a strategy. Even when you enter into a forward market and it's not in your favor, you take a long position by buying. We call it long position. I'll talk about it in hedge. And then if you think that price will change, that will not be in your favor, you take the opposite position. We call it short position, to sell it to somebody, at least to mitigate the effects of if you're not going to nullify, what do you call it, and neutralize your position and get, let's say, no loss. You can take the other position to sell it quickly, at least to reduce the expected loss. So there's a strategy to counter this. Right? There's a lot of strategies, straddle, and a whole lot as you move on. You are coming to the field of finance. So you will be exposed to different ways of hedging. You can combine 3 or 4 strategies, and then you minimize. So hedging is about like taking positions to neutralize or minimize your losses. So you can take position today, but there's another opposite side of it, option that you can take to offset the losses, either by selling it, the things that you have today. Today, you have, say, people, for instance, buy, let's say, some items and say store it with anticipation that it will price will increase. Now the other people who are also in the market that think that price will fall, rather the other people, market participants, that also think otherwise. You have store it, purchase more, store it. When unspent price will go up. The others that are also thinking opposite to your thinking. So you might find those when you want to sell the things, assuming that you expected the price to increase, but now you've gotten a hint that price will fall. You quickly will get people who also think that price will fall, so when price fall, they will buy. So there are always two sides of the market that you can offset your positions. And as we move on, we learn this. That's why we are calm. It's a theory that we are learning. And so I understand the forward, and at sometimes there will be slight changes. Okay? But the market has even gone beyond the futures market and go to options. There's options market. Okay, this when it comes we look at the time of delivery, there's also options market. So it's not only forward, we have forward, futures, options, where the delivery can take place at a later date. For the options, when you enter into the market of option and you buy, in the option, you have even two types. You have put option there, right? And in the option market, when you enter, you are not under obligation to exercise your right to buy or sell. In the option market, people pay a premium. All these things that we are talking about, even before this agreement can take place, you pay a premium, a price to get this contract. You pay a premium to the seller. Later we understand it. So it's the beginning. So I don't want to confuse. So let's understand that we have cash market and our spot market. Okay, we have spot market is on the cash market, and you have forward, futures, and options market. In this forward, futures, and option market, the delivery of these items will be done at a later date, agreed, but the date will be agreed at the time of negotiation of such contract. And in the futures market, the data are standardized. You go there and it's quoted. The amount that you can buy, the minimum that you qualify to buy is stated. The date is stated, where it will mature or expire, it will be stated. In the option market, similar things, the same dynamics. So that now, when it comes to the organization, we can organize the market also as exchange traded market, and then you have over-the-counter market. Okay, in the exchange traded market, it is well organized. Yes, please.
Please, with the forward sale, you said the delivery is always done at a later date, right?
Yeah.
Yeah. So do you have to make payments now and then delivery done at a later date, or you do the negotiation and everything, waiting for the date to happen, and then everything is done? Payment and delivery goes hand in hand.
Yeah, payment and delivery goes hand in hand.
Oh, okay.
But you negotiate at a date that a certain date to get the contract done. Instrument. The contract has become an instrument that you hold.
Okay.
Right? It happened even in these things, the farmers. Some people go to them, those who are doing rice farming, maize, and all those things, and go and negotiate with them when your items or the fruits or whatever mature.
I'll buy it.
Let's sign a contract. I'll buy from you.
But you don't make payment. You don't commit. You don't commit yourself.
Yeah, if you don't commit. So in the forward market, in fact, the individual can default on the contract. Easy. Because it's not well formalized. You have a farmer, or even orange, this thing that a farm, maybe a producer of orange. Even a company can go and talk to the orange producer and say that when the fruit matures, shall they supply it to us? We will buy from you.
Okay.
And they may even guarantee, they negotiate the price. Okay. It's happening in Ghana.
Yes, I know. I've worked in a company like that. But you see, normally when it happens like that, for you to honor the obligation, sometimes what they do is, my former company, what they do is, maybe they'll help you with farm inputs. They will not directly give you an amount that maybe in future, because we say we are going to buy it at this rate, we are giving you maybe commitment fee. We'll give you this. But what they can do, they will support you. So they come and look at your farm
practice. That for you is what's called premium in finance.
Okay.
Yeah.
So they come and look at your farm practices. They'll bring the agronomy to look at your farm practices. They will tell you the accepted one, the one that will let them accept your farm produce. And then sometimes they help you with the farm inputs. So at a later date, when all is said and done, then maybe if there are trade-offs, I don't know if you get me. So I don't know if that one is classified under
but
forward.
just that the company that does that with the farmer incentivize what you are saying is incentive scheme for the farmer really to give the product to the company. So that's why they are saying them with input and all those things.
Then I believe the best practices.
Yeah, the best practice to meet their distance.
To be accepted on the international market. It was an export, so for your product to be accepted on the international market, these are the best practices we expect you to put.
They sign a contract with the farmer to do that, and the farmer, when the contract is in place, the farmer has no right to sell it to any other place if they are able to. So everything is, when we talk about instruments and all those things are agreements, it depends on the enforceability of the agreement, the content that you write. So that is where it comes in. There's another market called the options market, where, for instance, the agreement is in place. The farmer, the one that you assign, good for sharing this experience. The farmer may say that, okay, I will supply you, but I'm not under obligation to supply the item or the fruit to the company when it matures.
Okay.
Are you getting what I'm saying?
Yes, sir.
That becomes an option market. When the farmer is able to negotiate in a contract saying that, don't oblige me. Obligation and will, they are different legally. So the farmer can say that I will supply, I agree, but can put into the contract that I'm not under obligation to give it to you to deliver. It happens there's a market called options. But for that to happen, for the farmer to have that right, assuming you are coming down to this level, for the farmer to have that right, where he will not be under obligation, the company will receive a premium also from the buyer, the farmer. The premium, how to pay something for the company also agree. We are giving incentive, we are helping you, we are doing this. But you also want to put in the contract that we didn't want to be under obligation to give it to us. Therefore, we are helping you. But before we can give that, you also have to pay us something for us to give you that right. We come to options market. So if that is not there, then it's just ordinary, like your case that you are saying, that it's just ordinary forward agreement that they have. We do the farm and supply us. We have an agreement, we buy it at this price for you. So that is a forward market. So this normally happens a lot in the commodity market. Maize, like I'm saying, there's a maize farmer in Tamale. Somebody wants or whatever, Accra. Somebody is in Accra, they want to export this thing, or they want to say they are doing kenke business at Accra, but they think that they can get maize at, say, Techima or Northern Region. They can go there and go and see the farmers there, negotiate 1 or 2 farmers, and set the price. At the end of the season, let's agree this is how much we pay. Now, the farmer will agree this. If the farmer anticipates that price, maybe at the end of the year, will fall. But you, the kenke businessman or woman, anticipates rather, at the end of the season, the maize price will rise. So you go and sit there and negotiate, and then you settle on a certain price that all of you think that is optimal for the two. Right? And depending on the content of the agreement, normally forward, because it's informally agreed, I mean, they can be defaults. Some of them may dishonor the agreement. But the futures market, you can't go there and do that. We come to the market. So this is replicated in the financial market. The instrument that individual can, if you want to buy shares, you can negotiate for shares and pay, any delivery will be done at a later date. There's forward market for shares, forward market for currency, forward market for bonds or debt instruments, right? Good. Now we come to the exchange traded market and over-the-counter market. Now in Ghana here, you see that we have the Ghana Stock Exchange. US, they have the New York Stock Exchange. Now this is a formalized kind of financial market where it is well regulated, rules are there, prices are displayed. These days, we are lucky in living in a technological world where the prices are displayed even through the web, internet. You sit in your room and it's there. If you want to buy or sell any as an investor, you can even sit behind your computer through your broker, get a price for you, or you observe what is happening, and then you buy from the stock exchange. This is a exchange traded market. Rules are there. You have to meet certain standards. If a company wants to get listed and issue shares, there are standards and rules that you need to meet. So we have exchange traded markets, but you also have over-the-counter market where transactions are not done on the stock exchange. A company may want to raise or want to borrow or want to raise funds. And there are a lot of companies like that in Ghana here. A lot of them are here. Such companies are not listed on stock market, but they still have issued shares and they have borrowed from the market. Okay? They are able to borrow from individuals. They sell or they issue instruments. There are lots. I don't know your experience with us, where some of you either you have bought or working in a place that the company have issued shares or sold securities such as hello.
Yes, we are here.
Hello,
Okay.
sir.
Yes, Doc. We lost
We
you
are
for
saying
a
you are
while.
closing 6.
We lost you at some point.
Yeah, I think the internet
Oh,
dysfunction
okay.
a bit. Yeah, it's more function. I don't know what happened. The table net, I mean MTN. So and I was asking, can anybody share his or her experience with us? Either you have bought a share in a company which is not traded on the stock market, or you are working in a company or a firm where they have issued shares, but they are not on the stock market. Can you? Class, are we closing? Is it 6 or 6:30?
6:30.
Okay, I have to finish this slide. Yeah. Can anybody share such experience with that? Okay. Now, there are certain companies that are not listed, but they still get they can issue shares, right? Privately. We call it kind of private market, not in the public exchange, right? They are not publicly listed, but they can still, and you have such companies in Ghana here, right? And their shares are not traded on the stock exchange. So when they issue shares, they they approach individuals through their other investment bank or other channels, right, to sell. I remember that the time that I finished school, I was posted to one district, and then it's a long time, getting to 30 years back. I was posted to that district. So, when you finish school and doing your national service, it takes time for you to even be given your allowance. This thing that they are experiencing in Ghana here, where people go on national service or they get their employment, it takes a year. Mine take 2 years. I have not been paid. You are employed, right? Government has employed you, but they are not paid. You need to rent an apartment and the rest. So I got to the point that things become very hard. Young guy who have finished school. So I approached the bank, one bank at the district. And so before you are giving the loan to rent the apartment, firstly, you have to buy shares. So part of the loan, that I took, a portion of it was taken to buy shares compulsory for me. So that is that mechanism. They use that mechanism to sell the shares to me. In other companies, they can do what's called private placement. The place and the sale of shares of financials can be done publicly on a listed or stock, what do you call an exchange. But there can also be what they call a private placement, where companies, firms can issue shares and then they can sell it to individuals, not necessarily on the stock market. So such exchanges that goes outside the stock market, it is classified as an over-the-counter market. And it's a big market. In the banking sector, is there, right? I mean, when you talk of this thing, for instance, if you want to buy currency, I mean, they are not done in a stock market. Such instruments and other things, you go to the banking sector or you go to Foreign Bureau and get some of this thing done. These are part of the over-the-counter market. I hope you are clear.
Yes.
Yes, sir.
Yeah, companies can borrow, right? Companies can borrow like that. For instance, you go to a bank. Let me say this: you go to a bank, and the bank, some of them issue what's called certificate of deposit. In Ghana, here we call it fixed deposit. Fixed deposit instrument. I think we have seen some or heard some before. Fixed deposit. Is there any banker here?
Yes, sir.
Kingsford, are you a banker?
Yes, sir.
Which bank, please?
CBG, Consolidated Bank Ghana.
Yeah. I think you issue fixed deposit there.
Yes, sir. We should fix deposit.
Call it fixed deposit. Normally, that is a what do you call it? Certificate of deposit. When business issue it, companies usually call it commercial papers. So banks issue fixed deposits. It's an instrument, but it doesn't occur. People go and buy it 3 months, 6 months, and so forth and so forth. These are instruments that occurs in the bank. They are traded in the bank. You know, they go and buy this thing are quoted to you, the interest rate or the returns that you get. If you like, you enter into that contract or agreement, and then they give you the what do you call it? If you agree with the term, the certificate is given to you. You pay. It's an instrument. It's a financial asset that they have issued or they have created, and then you also buy it by giving out the money. But this doesn't occur. That transaction doesn't occur on an exchange. So that market is over-the-counter market. So all the financial exchange and that occurs outside the stock exchange are classified as over-the-counter market. You can buy dollars, can buy the Foreign Bureau and other things. You can buy, companies can borrow by issuing what we call commercial paper. Companies issue commercial paper. And normally they do that with investment bank. And then individual or companies, other companies or institutions can go and buy such commercial papers and pay for it. When it mature, they go and receive their interest and then repayment of the principal. They call it commercial paper. When banks issue it, they call it fixed deposit, right? When government issued T-bill, right, to borrow, it is also that. And T-bills are not traded even on the exchanges. So a huge over-the-counter market is there. So in the market also, we have brokers, we have dealers, investment advisors there. Okay? Some of them these are firms. You have to register licenses, but each one has their own modus of operandi, or they are limited in terms of what they can do. Broker cannot take deposits, and this, as I explained earlier on, their work is to list potential buyers, get a list of potential sellers, and get them together. At least they can open, some of them, they can open broken account with for you. So when the deal is done, you pay into, and then they transfer the money into the seller, right? So for some of the brokers, when it comes to the exchange market, it's there. We have brokers there, FS Pro, those of you who are watching football and those things, and international, this thing. All of them are there. So they offer brokerage service. How do they do that? Their work is that they really find those who are willing to sell their instruments, and then find those who are willing to also buy. They have create a list of this participants in the market. They have a list. So people place order. Investors play order. I want to buy, let's say, this AGC share. I want to buy GBC, or I want to buy this company share. So they place the order, and this is the amount I want to. And this is the price that we are willing to pay. So they create all those things there. Some also come and want to sell all those things. So they match buyers and sellers. That is their work for a fee. And they have gone beyond that, opening accounts where if the selling or the exchange is about to take place, if they agree, the agreement is done by the price and everything, the buyer pays into the account. And they also ensure that the seller also submits the asset, right, the instrument to facilitate the exchange. And these are licenses by the Security and Exchange Commission to offer that service. Some of them are dealers. Have I received a question? They are saying no sound. Okay. Please, can you get a sound now?
Yeah, we are here.
Okay.
So it's better now.
Look at them. Okay. Look at the message. I think this thing is disturbing. I don't know if it's, I don't know, the internet. I'm using MTN table. Is any MTN worker here? They say, yeah, this thing is disturbing. So, some of them goes beyond that. Some of the firm, they also serve as dealers. Now, can anybody tell me who a dealer is in any market? A dealer. Yes, it's some of the things that we normally use, the jargons that we normally use in our market in Ghana. A dealer, who is a dealer in any market?
It's actually more or less like a middleman.
Mm-hmm. And that's all.
In a market, yeah.
Any other contribution? Serve as a middleman? Partly so, but not fully. Any other? A dealer. Oh, Ghana, we normally use this.
So please, it's a businessman who buys and sells goods, usually for profit.
Businessman who buys and sells goods, usually for profit. Okay. So when you go to Circle and somebody sells a mobile phone, he comes with a mobile phone, 2 mobile phones in his hand, and sell. He go to the market and buy from a shop and then come and sell too. Those who are passing by. Is the person a dealer?
Yes, please, he's a dealer.
Okay. Now, in the market, those who are considered dealers, they are those who buy the items in bulk, stock it with the expectation of what?
Higher profit.
Getting profits from it. So they normally buy the difference that they buy in bulk, large quantity. That is the difference. They buy in large quantity, a dealer. So in the financial market, we have dealers that buy financial assets also in large volumes. Keep it for future what? For selling in the future. Those are the dealers, and they help to guarantee price a lot. And these are firms and business. So some of the firms in the market can be a broker only. Some of them can be broker and also serve as dealers. Some can also be only dealers. They don't offer any brokerage service there. But normally, the dealers are also offer brokerage services. Depends on their capacity and the license that you hold. So in the financial market, your brokers, your dealers in there, and they offer the same. And normally, these are investment banks. The investment banks offer such services. Okay, they offer brokerage service, they offer dealing services as well. So they for them, if you are a dealer, they buy for their own interest to get a profit out of that. That's what I'm saying, their own interest, with the interest of getting out, selling it in the future to get a profit. But the brokers, their participation in the market is just to match buyers and sellers. In the market, we have invested is in Ghana. I took it from some time past. I need to still have to do my research and updating. This is about 6 years past. But you know that in Ghana, I wanted to enrich my this thing with Ghana content. Always we use content from the developed market, American and UK. Move for them, their data is. But in Ghana, we are looking for data to enrich your this thing presentation. It became very difficult. So I've been using this. So these are the numbers of companies that are serving as dealers, brokers, and dealers in the market. Investment about 11 firms as of 2019, right? And those who are purely dealers, primary dealers, like the investment bank that buys and guaranteed new issues are just 13, right? So these are institutions there. We need to understand it is part of the market. And I brought the industry, their financial positions, and how much they are getting. So these are for your own reading. And these are some in Ghana here. These are some of the securities or dealers firm that we have in Ghana. Okay. We have Algebra Security, GSF Brokers, Apakansi, Data Bank. Data Bank is common, where our previous finance minister is owner. Data Bank, I learned the history that it started with Togo Afede and Kena Ofurata. So we have IC Securities and the rest of the brokers. These are their transaction values that they, as of 2019, right? It's outdated data. It's outdated data.
As at 2025, we have 32 companies who are broker dealers.
Good. So you kindly share that one. Do you have all the names and everything with us?
I'll find out for you and send it to you.
Okay, fine, and share it so that I can update my listing. Thank you. So about 32. So, I mean, when people are doing finance and all those things, I mean, these are areas that you can go and you can establish your listing firms even there after the program, right? Take 1 or 2 professional courses and then you register. I think brokerage and all those things, you go to Ghana Stock Exchange, you register, you write 1-2 exams, you give in analysis, and we can start, right? Can start your own this thing. And if you want to look at jobs, people believe after financial in Ghana here, doing finance, the place that you have to go is to go to the bank to go and find. No. There are lots of jobs out there. It's not because of ignorance that people say if you do finance, you don't get a job. Sometimes I laugh a lot. So these are, thank you, we have 32 of them. So in fact, all the things that I've explained, I mean, are here. And now I'm coming to also, I mean, I'm done with all this exchange market. What is it? Okay. Trading is conducted in a centralized location, like Ghana Stock Exchange, all those things. Over the counter market, I've explained. Okay. We have dealers it's almost time. So we have dealers. Dealers are part of over the counter market that help to say, if when it comes to even the currency, you have dealers, you go there and they help you get that. Now, we mentioned that financial assets, financial instruments, I mean, they are interchangeable. When talk about financial assets, they say financial instrument. These are some of the instruments that we can have, especially in the money market, where financial assets are traded under just 1 year. So in Ghana here, we have treasury bills. We have 99-day treasury bill, 180, right? Sorry, 90-day, 91-day, sorry. 91-day treasury bill. We have 180. And you have what? Is it 360? So those that are this transaction under 1 year. So that treasury bill. Which institution or which market participant issued treasury bill?
Is it a commercial banks?
No.
Bank of Ghana.
Central banks.
Who?
I mean the central bank.
The central bank.
Bank of Ghana.
A central bank.
Investment companies.
No. Central bank, no.
Government of Ghana. The commercial banks.
No commercial bank. Government of Ghana. Or government. But the central bank does that on its behalf.
Okay.
Right? And they have decentralized the trading of it now to the dealers. And the dealers in this market are the commercial banks now. In the past, government issued it through the central bank. So if you want to buy a treasury bill, you have to go to the the central bank as an individual and go and buy. And the certificate will be given to you. But now, things have changed. The central government issue it through the central bank, and the commercial banks and other related financial, they go and bid it and buy it as dealers. Now that is where the dealers is coming in. They bring it into the over-the-counter market, that is in their institutions. And the individuals that wants to invest in the treasury bill, you go to the commercial banks and then you buy from there. I think the banker is here. It's not what is happening in practice.
Yes, we buy from the central bank, then we also come and distribute to our customers.
Yeah.
Who are willing to buy it.
Yeah. So the central bank issue it primarily through, or the government issue it is the issuer is the government. Is a channel or an instrument government used to borrow for short term. It's a part of borrow for short term under 1 year to support other things that they want to do. The central bank does that on its behalf. You know, the banker for the government is the central bank and is the financial advisor for it. Let me put it that way. But it does that, and then the banks will go and buy it in bulk. They bid it. And then they also sell it to individuals that who wish to own or invest in treasury bills. So this is an instrument. There are characteristics of it, but we may not go in there. It's risk-free, right? It is what? Risk-free. It has never experienced haircuts. And it can't.
Not possible.
It is not possible. The previous government could not touch it because you can't touch the theory.
No go area.
But we were told bonds were risk-free, but they were able to touch it.
No, we get to bonds. Dr. Bright will come here, and later you will talk about bond. Bond has risk.
The theory has changed.
No, it's an old theory.
We're told
it was touched. I remember, Pa.
That's why the theory has changed. After touching it,
that's why I'm saying that bond is different from treasury bill.
Was it a speculation? Or
initially, we were told that one of the safest is government bonds.
No, those that gave you that theory.
Touched, the theory would definitely change.
No, those that gave you that theory, that all government securities, maybe you didn't get it well. You didn't get it well. Those who told that every government security is risk-free, didn't give you the right theory. It is only treasury bill. But other government securities are with risk. Are you getting it?
It's a bit confusing here because that's what we heard.
That's what you heard. You didn't hear it right.
We were told in class.
We were told, yes. That is the most secure. In class. It's the most secure.
Yes.
Which university? Which university?
I think now the theory has changed.
The theory will change.
Theory doesn't change.
Oh, that's why.
But I remember I got one.
That's why we call it theory.
This is a bit confusing. It's a bit
confusing. Have changed the theory.
No. Is it my university that you learn that all government securities are safe? No, it's not all. Some of the government, as I'll come to a lecture on government securities.
Sir, please, can you take us to the ones that are safe?
Okay.
T-bills.
Treasury bill is with zero risk. That's why we call risk-free investment all over the world. All over the world. It is that government security that we call it risk-free rate. That means that it has no risk or it has zero risk. Even in America, it is, when you talk about treasury bill, it has zero risk. And then the same in America. Any other government securities, those that government issued and is government bond or state bond, it has a risk. And that is why the returns on any other government securities often is higher than even the treasury bill. Okay? It's higher than not. So the other government security bonds, that government, other channels or other mechanisms or instruments the government use to borrow other than treasury bill, take it from me. After you go and read much about it, they are with risk. It is that reason why other government, when government was tight in terms of liquidity in the previous years, other government securities, they were even advised by IMF and other lenders to do that hair cutting, to cut people's head. Are you getting it? It is only treasury bill. So those who invested in treasury bill didn't experience a reduction in the interest rate or the returns that they were expecting, or the payment didn't receive a postponement. There wasn't any postponement in the date in terms of treasury bill. So the previous government maintained that at least they did not breach or violate that theory. So that is the theory. But any other instrument the government issue, apart from treasury bill, they are a risk. Take it from me. Bond government, bond 10-year, 20-year, 50-year, whatever. Government can default. So what call even sovereign risk. Sovereign risk. The sovereign risk is it can come from government securities. So when you do risk analysis about instrument, we have sovereign risks. That is risk that you can get from security. And those of them even surprised that government securities have been downgraded over time, even by Fitch and other Moody's, Standard and Poor, and other things. Have you heard it in Ghana here and elsewhere? Government securities, when it comes to ratings and all that, they have been downgraded sometimes. It means that they are risks. When you are securities, this thing are downgraded, it means that it has risk, except the treasury bill. So all other government securities comes with risk, except the treasury bill, right? So it has zero risk. So if you want to guarantee your returns, the safest is to look at what treasury bill. The reason why, perhaps, I don't know whoever gave you that idea, the reason why maybe they may think that relatively government, Hollywood government, or estates, let me put it that way, relatively, their instruments is safer than when you invest in corporate, because corporates can go collapse. Government cannot collapse. It is only a change of government that can happen. Okay? States or countries, unless, of course, maybe war, another thing. Now, even in war, when new government comes, you try to pay all the other debt, unless, of course, it is written off as we went to EPIC. But other government securities, relatively, we say that because governments do not experience a dissolution, or we cannot sell, or government cannot collapse. It is only NDC and MPP that can collapse.
Then it's not safe to put our money in the cocoa bonds.
Where?
The cocoa bonds they have announced. It's not safe to go and put our money there.
Bond is bond.
Bond is bond. It's with risk. The corporate and the cocoa bond, this thing is cocoa bond is, say, later we come to classification of bond. This is even is an estate institution. Elsewhere in the developed market, they have even metropolitan bonds. There are lots, types of bond. Dr. Brian will take you through. There are types of bond, metropolitan. We have corporate bonds. We have this. So in Ghana here, we don't have some of this thing. But what cocoa bond is, it is state organization bond. And it's with risk. It is with risk. But relatively, compared to others, when they are individual, they cannot pay. In government can raise revenue elsewhere to come and pay. But don't think that government cannot, or this is true, and this is a true theory. And the experience that we've seen the previous distinct government should tell you that empirically it is supported, isn't it? So don't think that cocoa bond is sweet. But they are experiencing difficulties even with international price of cocoa. Government is raising, is borrowing, selling the bond. They have announced anything of that sort. I have to go and read. Government is borrowing, but government is backing it as a guarantor, thinking that even cocoa bond find itself and they cannot pay. Now they are raising this to go and buy cocoa. Now when the cocoa bond fair challenge, assume that cocoa price again falls in the international market, and cocoa bond cannot pay, they may have difficulties. Now even they could not pay farmers. Farmers were crying. Last week, I think even started in my head about it, the month where farmers said that they have sold their cocoa but they are not receiving payment. So if they defaulted in payment for the cocoa, actual cocoa, how can they default in the amount that they borrow? They can default. The government can default. Just that, as government cannot collapse, they can raise revenue when cocoa board is not in place by taxes, at least to pay. But just as it has happened before, even with head cuts, where payment of bond, some of the dates were postponed, and then they have to sit down and negotiate. It's a lesson to any investor in Ghana.
Okay.
So that is it.
So
I think it's time,
yes,
isn't
please,
it?
it's time.
Good.
All right.
So I'll share this material. I've explained the content. It left with few this thing with you. All things that I've already I've already explained it. It left with the internationalization aspect. And I think I had a bit of hedging. We'll look at it in our next period. So thank you for joining.
Thank you, sir.
Thank you, sir. Thank you.
Very nice.
Thank you very much.
I'll share the slide with you so that you take it.
Okay, sir.
No, do we have a class tomorrow?
No, please.
Okay, thank you.
Mm-hmm.